So basically, I want to start out by just talking a little bit about what these will entail throughout the semester. I'm trying something a little different, a little new. But basically, every Monday and Tuesday, I'm going to have these hours. Now, the first portion, the first half of them, or a little bit less than half, but about 45 minutes, I have a sort of predetermined lecture agenda. Things that I want to cover, things that I think are important, or that I've had students sort of misunderstand in the past. Little linchpins, I think, in understanding the topics that come subsequently. So even though they might not seem like a big deal in the moment, or these kind of like, why is he spending time on this? Hopefully, it'll become a little clearer to you in the future. The first 45 minutes, or say roughly 45, 50 minutes, I will record and upload for everybody. After that, basically, I open it up to whatever students might have issues with. If you want to watch me work a problem that you're having issues with, I'm down with that. If you have a really specific topical or course question, also down with that. It's up to you. Um, and so that time is reserved for you. Now, I don't want to record that necessarily just to hopefully, and I know some people might be like, I don't want my question recorded. Yeah, I get it. I've gotten over it because I've done so many of these that I don't even care about the recording anymore. I'm like, oh, I made a tiny mistake. I'm going to fix that. We're going to move on. But yeah, so I'm not going to record those. If people seem to give feedback like, oh, I don't care, I'd ask a question either way, I might record that as well. So that's kind of the plan. I'm going to go through these notes, kind of annotate them like I do a foundational video. If you have any questions, then feel free to unmute yourself, speak up, ask a question. More than happy to entertain those as I go through the material. It would help me actually, because otherwise I start feeling a little bit like I don't like the sound of my own voice because I've been talking too long. So break in with questions if you need. And otherwise, enjoy the show, get something out of it, and hope it helps. So, what we're really going to be looking at, and I'm switching to my doc cam now, is the basic definitions of assets, liabilities, equity, but more specifically, revenues and expenses. This is at the point when I feel things get a little trickier for people. The revenues and the expenses, the cash system versus the accrual system. This will lead up to tomorrow. What I really am going to start talking about then is the difference between cash and accrual systems, and how accrual is really a cash system, but then expands to incorporate other information as revenues and expenses that is more well suited to judging the financial health of a company. So that's kind of where we're going. Going to cover some of the basics here today, and then going to apply it into different ideas about cash and accruals tomorrow. So the basic definitions of our accounting system. And understand one of the things about accounting definitions you have to be really careful about is we need to distinguish between layperson's terms and accountant's terms and what I mean about this is that we will sometimes use words that you've used your entire life. And those have radically different definitions in our day-to-day life than they do when we're talking in particular about a financial reporting system. Some of them not necessarily different at all, but it's a big enough trap that people start to sort of conflate the two when they're in the accounting course, and we need to make sure that we think about this purely as accountants. So assets. Assets are pretty basic definitions. People that are pretty basic. People don't tend to confuse this one as much. They are simply probable future economic benefits for the company. So anything that is a probable future economic benefit to the company is an asset. And when you're thinking about classifying things as assets or liabilities, it does tend to be a pretty obvious picture as to what the asset of a company is. Now, liabilities get a little bit, especially at a high level that we're not necessarily going to get to at this course, can be a little bit more complex. So, liabilities represent future sacrifices of economic benefits if I can remember how to spell economic benefits involving transfer of assets or services from a present obligation that arose through past transactions. So it actually has a little bit of everything in terms of past, present, future. We are in the future going to sacrifice something that we own. That might be a transfer of assets, but it can also be services. So if someone gave me money to perform a service for them, until I've performed that service, this is a liability. It has to be an obligation in the present. So I'm still beholden to it, i.e., someone gave me money and expects me as part of the contract to perform services for them. Well, that's something that's happening in the present. And these tend to have arisen through some sort of a transaction where, hey, we borrowed money a year ago. We owe that money today. We're going to have to sacrifice money in the future to attend to that. So there's a three kind of part time field with this. And it's not that it's super important in this course, but it is something that you want to kind of remember and think about going forward, that we have this obligation from something that happened in the past, and it's going to involve us sacrificing in this future. Equity of all three of these terms, I mean, you could boil assets down to say economic resources, liabilities down to economic obligations. Equity gets a little bit trickier for people to really wrap their head around. The one word that I would, if assets are resources and liabilities are obligations, some people describe them as claims on resources, but it's basically the same idea. Then equity is ownership. And one of the best ways, in my opinion, to consider ownership in a business or accounting sense is to take what we know as the accounting identity or accounting equation, A equals L plus E, right? All of the resources of the company were obtained through one of two avenues. Either we owe someone for them, or someone invested in our company and is an owner of our company their investment provided the money to buy those resources. But the only way for assets to enter into an accounting system is either through borrowing or attracting investment. If we rearrange this so that we are defining E rather than A, we have that equity equals A minus L, right? So ownership in a company is what we have left over after we use our resources to meet all of our obligations. Any resources we have left over, that's the value of ownership in the company. If you want to think of a more real life example, think about ownership in a home. or any real estate, right? Your asset in this case, in the ownership of real estate, the asset is the value of the home or the building, whatever it is. The liability is the mortgage that is left outstanding on the home. And that is, I mean, if we're being really specific in accounting terms, it's a mortgage payable. So when someone says, "Hey, I just bought a house," and you might things go through, and then people are like, "All right, well, so what's your ownership stake in the house?" The ownership stake basically is, well, how much could I sell the home for? What's it worth? Less, how much do I still owe on it? Because if I went and sold it, right, then that's the amount of money I would get, the difference between what I sold it at and the amount I still owed. So that's how we consider ownership in accounting is what is left over to the owners after we take care of all of the people who the company owes money to. And in a bankruptcy proceeding, it goes in that order. Creditors are paid first, and then the owners of the corporation are left with what's still there, the residual assets of the company. Another name for this that is often used, and honestly, chapter one is a lot about names and a lot about vocabulary, stuff we just got to remember and put into our minds. Sometimes instead of equity, we'll refer to this as net assets. And hopefully you'll start remembering that term because I tend to use them interchangeably, not to be confusing, but it's just the way of the accounting and business world that people are going to call equity net assets. Sometimes they'll call it equity, sometimes they'll say common equity, sometimes they'll say residual ownership. These are all the same ideas. And so start building that sort of vocabulary. They say accounting's the language of business, and they weren't lying, right? So those are the big boys in terms of where all of our accounts fall. Okay. Everything can be related back into one of these three. Now, revenues and expenses, they are in some ways a subset of equity. Because, if we think about revenues and expenses and where they fall, we have an income statement. We take all of our, very simple, very much simplified. We take all our revenues, subtract off all our expenses, and if we have gains or losses, we add any gains, subtract any losses, and that gives us net income. Now, net income does move into equity because net income feeds into retained earnings. It's another equation that hopefully is somewhat familiar to you from intro. What this says basically is I have a certain amount of earnings that were retained in the company to start at the beginning of this period, say January 1st. Over the course of the year, I had revenues, expenses, gains, and losses. When I combined all of those, I got a certain amount of net income for the year. Now we're at December 31st. We started off, say, at 1/1. We're ending the year at 12/31. So what the retained earnings is comprised of is the net income for the period, subtracting out any dividends we paid to the owners for the period, and that gives me my final retained earnings. This is an absolute equity account, retained earnings. And so in that way, revenues and expenses are a part of earnings because any amount of net income builds what the ownership of the company is. Right? So understanding that they're a part of equity, but principally they're a part of net income. I want to talk a little bit about these under an accrual system. Now, revenues and expenses, as far as I can tell, like they were first accounting terms And then lay people got a hold of them, and then they're sort of used for any positive movement of income or any positive news, like, oh, revenues are great, expenses are horrible. But technically, let's get real in the nuts and bolts about how to define these. Revenues under an accrual system, they are increases in net assets. So let's just take a moment and breathe that piece in. Right? Increases in net assets. Well, net assets, right, up here defined as equity. So really they're increases in equity. Well, then why do I bother saying net assets? I say net assets because I'm trying to get at net assets is assets less liabilities. And so how can we increase this difference? So how will A minus L increase? Well, that means that we could either increase an asset, that would imply an overall increase to my net assets, or I could reduce a liability, right? Because if I subtract off less, then I will increase this overall difference. So really, from a pure technical sense, revenues are an increase to assets or a reduction in liabilities. That's another way of reading an increase in net assets, but making it very specific. It's an increase in assets or a reduction in liabilities from the primary operating activities of the business. And in that, what's going to become very important to distinguish it from other items is the primary operating activities. So, primary operating activities just means, like, what did the business get in business to do? What is their business model? Are they selling retail goods to customers? Are they providing niche expertise and services? And it can be even as specific as the type of items they're selling to people, right? So, primary operating activities, best way to get a hold on it is think, what is the day in, day out activities of this company? Those are their operating activities. Now, expenses are just the opposite of this. But I do want to note one other thing about revenues that might help connect the dots a bit. If it doesn't, it's okay. But sometimes people appreciate seeing, like, how this works. Well, think about a journal entry. And I do this a little bit on the video, but if you think about a revenue, and if I record a revenue, I increase revenues with credits because they're credit-based accounts. So if I record a revenue, then I have a credit amount of whatever amount of money, and fill in the blank. Man, no pens are working except this one blue one. All right. Well, if I credit a revenue, then I need a debit account, right? I need something to debit. Well, by our definition, the only two things that make sense to debit when I've credited a revenue are an asset account or a liability account. And the definition follows pretty clearly because if I debit an asset account, well, that will increase assets. If I debit a liability account, that's going to reduce liabilities. So anytime a revenue is recorded, there's an effect to an asset or liability. Okay. Now, like I mentioned, this is going to be the same except mirrored for an expense. So expenses are just reductions to net assets And of course, the way to reduce net assets would be the opposite of how we increase them. We would either need to lower assets or increase liabilities to get A minus L to be less to reduce this difference. That will lead to an overall reduction to A minus L. And the same for increasing what we're subtracting from assets. And the same truth applies when we set up a journal entry and we say, okay, well, I want to record an expense. Well, if you're going to record an expense, you have to debit it because it's a debit account. Now I need a credit. And the only two things that I can credit if I debit an expense are, again, an asset or a liability. So for any transaction outside of closing entries, this becomes our sort of guidepost. I don't feel like students sometimes enough rely on start like almost filling out a journal entry like a Sudoku. Like, okay, I know a revenue has to go here. Well, then that means I have to credit it. So really what I'm looking for is a debit. And now that I need to debit either an asset or a liability account and then kind of approach it that way, rather than just be like, oh, these words should have sparked an immediate reaction to what I should debit or credit. Use a little bit of these definitions, the nature of how these terms work with each other to help you fill in the pieces, if you will, to be more comfortable filling in those pieces. Right. So I want to just stop here and see if anyone attending has any questions about these. You don't have to, but if there's anything I said that seems uncertain, or confusing, let me know. All right. Well, of course, as a big picture idea, these three items are on balance sheets, and then these two are on income statements. And just be really careful with saying, okay, using this idea that revenues and expenses are related to net income, which is related to an equity account. Don't go so far as to say, well, revenues and expenses, gains and losses are balance sheet accounts. They're not. They they inform a balance sheet account, retained earnings, but they are not themselves present on a balance sheet. Um, so income statement accounts under an accrual system. So now let's talk about when do companies record revenues and expenses under the cash versus the accrual system. So under a cash basis system, cash basis systems have severe limitations on how useful they are. They tend to be used by, like, for example, your church might use a cash basis system. A small organization would use a cash basis system. Student organizations use cash basis systems. But if we are a business, especially if we hold significant inventory, and 100%, if we're going to follow US GAAP, we have to use the accrual method. So let's think about when do we recognize revenues under a cash basis system, and when do we recognize those under an accrual basis system? So under cash basis, the rule is very simple. It is whenever money is received, whenever, I won't even say money, but more particularly cash is received, that is recorded as a revenue. So in the case of a journal entry, or really, if you take this to its logical conclusion with revenues and cash and the cash basis system, it starts to limit our accounts. because if I debit cash, I always have to credit revenue, right? There's no way around it in a cash system. Under an accrual system, we use the revenue recognition principle. Sometimes the revenue recognition principle goes by the name of the realization principle, but either is acceptable, and the first is definitely more obvious, right? So revenue recognition, what does that mean? Now, recently, and I say recent, and that ages me because I was like, actually, that was like 7 years ago now. It wasn't so recent as I want to think it was. Um, they really revamped the revenue rec system for our purposes in this class. I boil it down to still two primary ideas that we have earned or earned. What is that? Earned is fine. I was going to say something else. Earned. um, we've earned payment by providing the goods or services. Right. So basically, we have to have done the work. I was going to say discharged contractual obligations instead of earned, but I was like, yeah, it's earned is fine. Okay. Earned payment by providing goods or services. So we enter into contracts with anybody as a business. Once we've discharged our portion by providing goods or services, that's the first criterion of the accrual system. We also have to have a reasonable expectation of payment. This one is more of the is it realizable? Realizable. That's where the realization principle comes in. Um, do we have a reasonable expectation to receive money? So we have to have that expectation that we're going to be paid what we expect to be paid. And we have to have earned it. We have to have provided a good or a service. So if you think about how that affects, how we record some things in accounting, um, for example, a credit sale, that's one way that we can record a revenue. And a credit sale just happens when they don't have the money to pay us right now, or they're not going to pay us money right now. It's not that they don't have it, they just won't. That's when we record it as an account receivable. And we go ahead and record the revenue because if, right, if we've provided that good or service, then we can record a credit sale as revenue even when we haven't received the payment because we have a reasonable expectation of payment. As long as we've earned the payment, we can record this credit sale. Now, if you think about how it happens, this is when someone's going to pay us after our good or service. When someone is going to pay us before our good or service, then we have a prepayment, and this turns into an issue because if they're paying us in advance, we receive cash. So the second criterion, there's no problem with that. Yeah, we have a reasonable expectation. Well, we actually got cash. Now, have we earned that payment yet? Not necessarily. Until we can't record revenue here. We record this as unearned revenue or deferred revenue. Most companies use the term deferred revenue rather than unearned revenue, even though unearned is probably more familiar to you. So here's an example of us receiving meeting criteria two, but not meeting criteria one. So one is not checked, two is good. Right here, we got both going because We recorded a receivable. We have an expectation to receive money. And if we've done the work, then we can go ahead and record that as a revenue. The final way the accrual system is by just doing what a cash system does, is if we receive money the moment that we're providing goods or services, then that is cash and revenue. Sorry, I kind of ran out of room in the middle here. This is what we call a point of sale revenue. So this is a very common transaction that you and I engage in every day when we roll up to the drive-through window or roll up to the barista counter, right? We handed our cash. The company is simultaneously giving us the product or service that the cash has entitled us, the consumer, to. So the company would debit cash and credit the revenue at the same time, right? So basically, three different ways that a company can perform its operations, its operating activities. It can get prepayments and do the work later. It can collect the payment at the same time they do the work, or it can do the work in advance and receive payment later. And the accrual system helps me identify when to record the revenue, right? In these two cases, yes, because the work's been done. In this case, no, because we haven't earned it yet. It tells me when to record a revenue, not based on whether cash came in, but whether these two criteria have been met. So that's the rev rec. And, again, not that one doesn't tend to be a problem for people so much. Just a basic understanding would tell me, hey, I got cash, but I can't call it a revenue until I have earned it. Okay. That's usually the one we deal with the most in our class. All right. Let's apply it to expenses. A little different. It's definitely a chicken and the egg thing when we think about how to record expenses under an accrual system. And hopefully that I'll allude to that idea again. But basically, to really get it correct, we have to figure out first what are all the revenues this company is going to record this period, this accounting period. And two, then we assign the expenses based on that. So we want an idea of our revenues first so that we can include all the appropriate expenses. This cash basis piece of expense recognition is just as simple as the revenue recognition, or is just as simple as cash basis revenue recognition whenever cash is spent, right? Whenever cash is spent, we record an expense. And again, it doesn't allow us a lot of flexibility in a cash basis system. Consider, hey, I just spent $30,000 to buy a company car, right? Well, debit equipment expense, debit equipment expense, credit cash. Um, there's no room in a cash basis system for assets other than cash, right? So there's a huge limitations on that. Um, let's talk about the accrual system. When do we recognize expenses under an accrual system? And the expense recognition is what they call it now. The FASB just switched gears on that. Again, like this time in the past like 4 years. They used to call it the matching principle a lot, which I thought made a whole lot of sense. And maybe you'll see why when we pick apart that definition a bit. But the expense recognition or the matching principle, what this tells me is that I want to record expenses by matching them to the same period as the revenue, sorry, the revenues they helped generate, right? So, when we spend money as a business, we're not just being philanthropic, right? We're not just giving it away. We are spending money to make more money. We're spending money to pay our employees so that they can make sales. We're spending money to buy more inventory so that then we can turn around, mark it up, and sell it. We're spending money on advertising in order to get more customers in the door, right? Spending money on promotional deals so that more people will buy our stuff. So we're spending money with the idea that there's going to be a benefit in the future from it. Well, what the expense recognition principle says is basically, I don't care when the cash was spent. When will what the cash was spent on benefit the revenues of the business? And notice, in order to really match them appropriately, in order to determine what expenses I want to recognize, I have to know what revenues I already recognized. So that's the whole chicken and the egg thing. First, I need to know, well, what was the source of my revenues? How much money in revenue am I taking in? Then I can say, all right, well, what were all of the costs of making and recording these revenues for the period? I need to match those expenses. So I want to illustrate that a little bit because the matching principle tends to be the one that can cause some confusion for students. The first piece is to talk a little bit about depreciation expense. So this is a personal pet peeve of mine, and they always say pet peeves are more telling of the person who holds them than than the people who violate them. But depreciation is not just strict wear and tear. All right. This is an example of when the accounting world and the lay people who aren't accountants can disagree on the definition of a term. Because, yes, when we talk about depreciation in the real world, we're talking about, hey, as soon as you drive the car off the lot, it's worth less, right? So we're talking about not even necessarily wear and tear, but just the value of the thing. And that is not really representative of how we use that term in financial reporting. In financial reporting, right, the depreciation represents the cost of obtaining the long-term asset, right? So we went out and bought that car for $30,000. Now, what depreciation is going to do, or the first thing the accountant would ask is, okay, the car's valued at 30,000. So that was the cost of obtaining the asset. Well, the first thing I would ask is how long will it be useful for? Or how long will it be used in the business? Maybe we are starting our own, DoorDash food delivery service, whatever, obviously late in the game at this point. But we're going to use that car to make deliveries. And we think, hey, this car should run fine for, 10 years before we have to replace it. All right. Well, then it says, all right, how long will it be used in the business? But really, even more pointedly, how long will it be used in the business and help generate revenue? Because certainly part of my revenues of delivering food to people who don't want to leave their home is going to be to have a car to do it. And so then I want to match this $30,000 over the entire, say, 10-year useful life. So if the answer to this question is 10 years, then one way to do that, and the one that's most commonly used, is straight line and saying, all right, well, then rather than recognize all $30,000 as an expense this period, because this car is not going to just generate profit this period. We want to divide it over 10 years so that we show, on average, essentially, that whatever revenues we make should be offset by a $3,000 depreciation expense because we're using a car to make these deliveries. We had to spend 30,000 to get 3 years out of, or sorry, 30,000 to get 10 years of service out of it, right? So that is what depreciation is. It's not saying that the market value of this car is dropping, the market value being, okay, after 1 year, I can only sell it for 27,000. Okay, well, after year two, I'm only going to be able to sell it for 24,000, right? The economic reality is after the first year, we could probably only sell it for 20 if we were lucky, right? So depreciation does not track real value. It's just parsing out the total amount we spent as an expense to the same period that it'll help generate revenues, which we said was 10 years here. Um, with that, my gosh, I always talk longer than I think. Um, there's two other examples I kind of roll through here. Why this makes sense, like why does it make sense that we want to measure it this way? So now you know why, that we measure it this way. I want to give you, well, why would I care if I was running a business? Okay, so let's bring it to our personal life, right? So we're budgeting for a purchase in our life. Our cars, clothes, laptop, these are the assets that we use in the everyday operations of living my life as a student, right? So these are my this is, if you will, the business's core operating activity is just getting it done as a student and living your life. Well, you do have some, obviously, your student life has some other things, liabilities, credit card debt, car note, whatever. But meh, our laptop is fried. We're going to have to get a new one for $2,000. And I expect that I'm going to be able to use this laptop for 5 years. And before you're going to want to get a new one. But you're worried because you're like, but my normal budget is $1,000 a month. Okay. So this $2,000 expenditure, it feels like it's going to sink you, right? If you had to report a $2,000 expenditure on your monthly income statement as a student, man, you usually only have $1,000 of expenses. Now you're adding another 2,000. That's like 3,000 for a particular month. Does that mean your life is going to be now this way for the numerous months ahead? Of course not, right? So if I spend $2,000 on cash, should we be worried about this for our operations? Why or why not? Not likely because it is a one-time expenditure that will last for 5 years. So 60 months. So now you're kind of thinking, all right, so don't have to pull the panic button, right? Um, but I do want to make sure that I account for this in some way that's meaningful in my budget. And the best way to do that then is to understand that, well, if it's going to take 5 years for you to have to replace this, then this is only an expense that comes around once every 5 years. And so to appropriately budget for this expense that's only looping around once every 5 years, we can then do a calculation to say, well, how much per month should that really be if indeed it's going to take 5 years before I have to go and set up another laptop. So 2,000 divided by 60 months or 5 years tells me really that as long as I'm making sure I keep money around for $33.33 per month, that will cover me the next time I have to buy a laptop. All right. Just one moment. All right. So if I was going to, use this laptop to help generate revenues for my life, right? Match it to the revenues it helps generate. How should we record the $2,000 cost of the laptop? Well, the first, of course, would be under the accrual system. I would record it as equipment, just the catch-all asset. I use the term equipment. If you debited computer, if you debited laptop, if you debited machinery, I'm not going to be worried about that. But you did spend $2,000 on it, and presumably we use cash for that expenditure. So we just exchange one asset for another asset. Now, this is at the initial purchase. We would only incorporate the adjusting entry at the end of the period. And depending on how long the accounting period we're talking about is, because accounting period really, there's three, there tends to be three accounting periods that are used by businesses for different purposes. But we have annual, quarterly, and monthly. So if I'm looking at a monthly record, then I would divide the 2000 into months, and I would record it as a debit to depreciation expense and a credit to accumulated depreciation for $33.33, $33.33. If we were doing a yearly, then I would take the 2000 divided by its 5 years and say, okay, well, rather than focusing on $33.33 a month, this is $400 a year that I have to save in order to get my next laptop. So if we were adjusting at the end of a year, I would debit depreciation expense for 400 and credit accumulated depreciation for 400. Okay. We wouldn't do both, not both, one or the other, right? Because it just depends when our company decides to reset its books. Okay. But this is the idea of depreciation. It is more informative to businesses this way. They can get a sense that how much they have to stash in revenues or profits in order to buy that next laptop. They're going to have to get $400 a year or $33.33 a month. I want to go through just one more, and this one with cost of goods sold. You know, why do we match? So let's consider like a simple inventory business and cost of goods sold. And so we got this business, Florian. It began operations on January 1st. On that date, it purchased machinery for 100,000, and it's going to use that to manufacture goods. The company thinks it can use it for 5 years. It produced 1,000 units at a cost of $6 each during the first fiscal quarter of the year and made no sales. So we got a pretty simple company under the cash basis system. We're now what we're talking about is making income. So we're under the cash basis. Remember, when money comes in, we record it as revenue. When money goes out, it's recorded as expense. And we're looking at the end of the first quarter. There was no sales made, so no money came in, right? So our revenues under the cash basis are zero, but we have a number of costs. First, we purchased machinery for $100,000. So that would be like a machine expense or something of that sort under the cash basis. $100,000 coming off of our zero profit. Um, it produced $1,000, sorry, 1,000 units at a cost of $6. So it cost them $6 each unit. So then they have like an inventory cost here for 6,000. Sorry. Yep, making sure that was right. $6,000, 1,000 units, $6 each. And those were the only costs we had. Well, thank God, because we're already in the hole under the cash basis by $106,000. This is my net income. All right. Now, under the accrual basis, we would still have we don't have any sales, so we still have no revenues. But the question becomes is did these expenses generate any revenues for this year? Um, and right now, or this quarter, I should say, I'm sorry, I said this year, but we're just looking at the quarter. Right now, they weren't used. So the machinery was used to produce units, but it didn't actually end up generating any revenue. So we still have zero expenses, zero revenues. So our company's at zero rather than in the hole $106,000. Now, this is an accrual basis income statement, right? Our company, under both scenarios, has spent $106,000 of cash. Both scenarios, 100, we have a negative cash flow. And that's something I want to kind of draw your attention to is that under a cash basis income statement is just the exact same thing as a cash flow statement, period. Accrual basis income statements are very different than cash flow statements. And so there's basically, and we'll talk a little bit about this tomorrow, the accrual basis does both cash and accrual stuff. It contains both pieces of information. Right. So this is what our simple income statement looks like for the first quarter. Let's go into the second quarter. So we're entering the second quarter. The company's producing some more. The company produced 2,000 units, but used more expensive materials and raised the cost to $10 per unit to make those. The company sold 1,000 units it produced in the first quarter at a price of $14,000 a unit, and that was paid in cash. No units from the second quarter were sold. All right, so now let's look at this. We got some revenue this time, and we received cash. $14 a unit times the 1,000 units. Under the cash basis, well, that's $14,000 of cash, and I can record that as revenue because it arrived as cash under cash, arrived as cash. That's how we treat these under cash basis accounting. What expenses do we have? Well, um, 2,000 units. We spent this money, $10 per. So we have more inventory expense, and it cost us $20,000 there. And other than that, we don't have any additional expenses under the cash basis system. So right now, my cash basis is showing net income of negative 6,000. Let's think about accrual. Well, if we sold the units, we provided the units to our customers, and we collected cash, we've met the revenue recognition criteria. So I can record the $14,000 of revenue. Now, what I want to record as the expense is all of the costs involved to generate this revenue. Now, what was this revenue? This revenue was from the 1,000 units I produced in the first quarter. So rather than use a cost of goods sold of $10, because the $14,000 of revenue came from these units, I want to use this cost of goods sold, which more appropriately matches where the 14,000 came from because I got that 14,000 from the shirts I created in the first quarter, not the ones I created in the second quarter. Notice the cash basis is kind of showing like I have a negative gross profit. that my revenues were not greater than the cost of the items I'm selling. But really, it's because this was used to create items I haven't sold yet. So there's a bit of a miscommunication going on here with this negative number because if I reflect on the true cost of goods sold of what I actually sold, then I have a $6,000 cost of goods sold, and that would leave me with $8,000 of gross profit. Basically, it makes my company, not makes it, but it reveals the reality that of the shirts that were sold by the company, I was able to clear a profit, which is not clear at all here. Now, I do have to add something else in terms of an expense because part of creating this $14,000 revenue was creating the shirts that we sold. We used a machine to create those shirts, and so we have to match part of the cost of this machine, thinking about how many years I'll use it to produce revenue, but match a part of it to these revenues I recognized in quarter two. So if the company believes it can use the machinery for 5 years, this is the math I would do. I'd take the 100,000. That's how much it cost me. I have to recognize $100,000 of expense eventually, but how quickly? 5 years? Well, that comes to $20,000 per year. But I'm not even talking about a full year, right? We're moving in quarters. And I would take that $20,000 for an entire year divided by four to get $5,000 every 3 months or every quarter. So then I include my depreciation expense here because that was the cost of the machine that contributed to the revenue of the shirts I sold. And I should show $3,000 of net income. Okay. I don't worry about this $20,000 cost of producing these new units until these units that I produced are sold in the next period. Okay. This is the idea of matching expenses to the revenues they help generate. These revenues were from quarter one shirts. Those quarter one shirts cost 6,000, not 20. You know, undoubtedly when I with my business, when I sell these shirts that I used a more expensive material for, I'm going to be charging them more than I charge them for the lower cost items so that the revenue from these new, more expensive shirts is matched appropriately to the cost of producing those shirts. So, this idea of the matching principle is not just a theoretical, word game that we're playing. It has real implications to measuring the performance of a company and understanding if I want this revenue, right? If this is the revenue that I've generated from the business, I should only put in the costs that were associated with helping to generate that revenue. The other costs, like the $10 per shirt for the more expensive materials, that's only going to come into play in the future when those are sold.